What's up everyone? Welcome to Wise Wealth, where we dive into all things personal finance. Today I wanted to focus on the US stock market, and more importantly, why has it been rallying when all the economic indicators are bearish? The last week has seen the markets move upwards consistently back to a level near the pre-market crash, despite 40 million unemployed in the country. Investors are ignoring pessimistic forecasts of earnings and continuing to drive share values up, combined with the Fed's artificial inflation evaluations with their own liquidity injections. Social unrest is rising, with some peaceful protests across the nation and others turning more violent, including riots and looting. Yet the market is ignoring all of this. Some states have even enlisted the aid of the National Guard and implemented curfews for all citizens. None of these signs are positive indicators for market growth. Are we running into a trap? Are we investing in the midst of a bull trap only to see our investments fall off a cliff? In today's video, we'll dive deeper into all of these points and analyze what stage of the market we could be in. As always, I must caveat this by saying that this is not financial advice and is purely my own thoughts on the stock market and intended for educational purposes. I'd always advise doing your own due diligence before investing your own money. If you're enjoying this type of content, be sure to hit the like button to let me know, and remember to subscribe to my channel. So without further ado, let's get into today's video. Firstly, let's look at the current levels of the stock market. If we take a look at the Nasdaq, the index is actually up year to date, sitting at nearly 9,500, up from 9,050 at the beginning of January. How is it that the index has rebounded so swiftly with the pandemic effect that caused the drop in the first place still looming over our heads? The effects on the economy are yet to be realized, yet the Nasdaq is in a better position than it was at the beginning of the year. This contradiction of the bearish sentiment is further amplified when we look at some of the comments of some well-known and successful investors. Stan Druckenmiller and David Tepper both recently highlighted the risk-reward of holding shares is the worst they've encountered in years. This comes after Mark Cuban pointed out that the market is overvalued, saying it's almost impossible to predict consumer demand. Consumer spending forecasts play directly into one of the main contributing factors to a share's value, which is forecasted earnings. And we'll touch on this in a couple of minutes. Druckenmiller called the idea of a V-shaped recovery, the idea that the economy will snap back as the pandemic fades, a fantasy. If this idea of a V-shaped recovery is seen as wishful thinking by so many in the industry, then why have we already seen this with the Nasdaq? Tepper drew similarities between the overvaluation of equities to those witnessed back in 1999, at the height of the dot-com bubble. The clear similarity between these two events is the valuation of technology stocks. Due to the nature of tech firms, they have been seen as a somewhat pandemic-proof investment over the last few months, with the share values in the likes of Zoom, Nvidia, Amazon, and more increasing significantly year to date. These have driven up the index more than any other sector, with FANG stocks, Facebook, Apple, Amazon, and Google carrying out such a significant weight in terms of market capitalization. When these firms see a large rise in share value, they have an immense effect on the index as a whole. If we take a look at the Dow Jones, however, we will see it's still lower year to date than its previous January values of 28,500. But it's only down roughly 10%. The rise in recent months has still been significant despite the tech firm's immunity to the pandemic, and the trajectory seems to still be trending upward. So what else can we put this down to? What other market factors are contributing to this uptrend despite the bleak economic outlook? The other factor that hasn't garnered much attention is the return of the retail trader. Many people have been confined to their own homes, whether they've been working from home, furloughed, or unfortunately out of work. The latest statistic to come out of the States was a record 14.7% unemployment, the worst since the Depression era. Over 20 million lost their jobs in April due to the virus. With so many at home, working or not, people have sought to bolster their financial situation through the stock market. As a medium of saving and making money from home, the markets have been seen as an attractive prospect for many, including those who have never invested before. Many of those at home are receiving stimulus checks from the government as part of the National Furlough Scheme. With so many at home allocating capital in the markets as equities looked to be trading at discounted values off their all-time highs, this surge in purchases has further driven the price of equities up. The lack of consumer spending has meant that people have looked to alternate ways to spend their money. In normal circumstances, we wouldn't see this taking place. Another point to consider is the changing nature of investor sentiment. In the recent months, we've seen the PE ratio of many firms increase dramatically, with the S&P trading at over a 20 PE ratio multiple. This shows that investors are less inclined to hesitate before investing when looking at a firm's earnings. The pandemic has had a significant impact on revenues for most firms. Forecasting earnings are a primary driver for share value, and when investors ignore these short-term fundamentals, it points out two factors to us. Firstly, the perceived value of the markets reopening following the lockdown outweighs the negative impact that this prolonged period of restrictions has had on earnings. Secondly, the markets are more forward-looking than just the next quarter. It seems that despite analysts' forecasts of GDP contraction, loss of earnings for firms in the next quarters, investors are looking 12, 18, 24 months ahead to when the market is expected to recover and see steady growth once again. While future prospects of growth and forward thinking is definitely something all investors should look forward to, we should also be wary that the markets do not spin out of control. If bullish investors drive the price of shares up too high in the near term, and we start to see a convergence of negative economic factors and even higher PE multiples, we could see a sharp turn towards a general bearish sentiment and another drop in share value. This is particularly significant when we take into consideration the next factor. As we mentioned previously, the return of the retail investor has led to a large surplus of invested capital in the markets. Institutional investors are also reshaping their portfolios to switch out of the pandemic-proof stocks such as pharmaceuticals and technology. What we're seeing is a sense of confidence in the markets that was only previously evident when it was at its all-time high in February. Investors are hedging their bets on the stocks, knowing that if they get it wrong, the Federal Reserve will bail them out with their massive investment in the markets. Recently, the Fed's balance sheet exceeded $7 trillion. The investment is not limited to mortgage-backed bonds, but also ETFs. The comfort that this has given investors has led to the artificial inflation of share values. The question we must now ask is, what happens when the Fed stops pumping money into the markets? This has put downward pressure on future interest rates, but with interest rates so low already, there's nowhere else for them to go. Finally, why has the market simply ignored the social unrest and political tension taking place not only in the US anymore, but across multiple countries? Over the past couple of weeks, we have seen protests against systemic injustices throughout the US against black people. These protests have extended to other major cities such as London and Paris, where, in some cases, individuals have jumped at the chance to commit crimes such as arson and looting. In spite of this ongoing unrest that has led to the use of the National Guard in many states across the US and the introduction of curfews, the market has been relatively untroubled by this and have continued their upward trajectory. Not only this, many retail shops have been vandalized and their stores looted. We've seen examples of these in videos all over the internet and social media. This has caused them to lose significant amounts of stock and forced many retailers to close their shops once again just as they were reopening. one of the hardest hit industries from the pandemic, is now facing further struggles to return to normal operations. And yet even their stock is still going up. This should be a cause for concern, as the rise in crime throughout the states will definitely impact these firms' expected earnings in the months to come. All in all, I think that the markets are experiencing a recovery that no one could have anticipated. Recently, Donald Trump described it as a rocket ship recovery. This statement came following the surprising jobs report that left people scratching their heads. Analysts expected the May report to show an increase of unemployment levels between 8 to 10 million people in the States. Instead, we saw unemployment levels fall to 13.3%, with payrolls adding 2.5 million workers back into the economy. This begs the question, is the economic situation we are in as dire as people projected? Have we seen the bottom of the market, and are unemployment levels set to rise steadily from here? If that's actually the case, then we may have some justification for the current market conditions. I'd be really interested to hear your thoughts on this, so let me know in the comments below. What do you think of the situation surrounding the US stock market at the moment? Do you currently have investments in the States and are thinking of offloading your stock? Thanks for tuning in today. I hope you enjoyed the video. If you found it useful, smash the like button, I'd really appreciate it. If you want to see more content like this, subscribe to my channel and be sure to hit that bell icon to get notified of new posts. I upload all sorts of videos on this channel, not just these types of videos, so if you're interested in investing, top fives, and personal finance in general, check out my channel for more. Also, be sure to follow me on Twitter as well for general investing information. If there's something of interest going on, but I'm not thinking of making a video on it, I tend to use that as my go-to social platform. So there's more content on there that you may like. Thanks for tuning in today, and until next time, see ya.